In Chapter 3 of the CPH, the Canadian Regulatory Framework, we discuss the basic principles of securities regulation. We're going to learn how provincial securities legislation functions and about the rules, regulations, and guidelines of self-regulatory organizations. So we're going to start off with the key terms for the chapter. An administrator is the securities regulatory authority in each province. The CIPF, the Canadian Investor Protection Fund, is a fund that protects investors against the insolvency of any dealer member. It is financed by CIRO through quarterly assessments on dealer members. The CSA, Canadian Securities Administrators, is a forum for the 13 securities regulators of Canada's provinces and territories to coordinate and harmonize the regulation of the Canadian capital markets. A dealer member is a firm that trades in securities in the capacity of an agent or principal and is a member of CIRO. A designated stock exchange is a stock exchange that has been designated by the Minister of Finance as qualified for investments in various registered plans. Disclosure is one of the principles of securities regulation in Canada. This principle entails full, true, and plain disclosure of all material facts necessary to make reasoned investment decisions. FinTrack, Financial Transactions and Reports Analysis Centre of Canada, receives, analyzes, assesses, and discloses financial intelligence on suspected money laundering, terrorist financing, and threats to the security of Canada. Integrated Market Enforcement Teams are an initiative of the RCMP and the federal government to detect, investigate, and deter capital markets fraud. The teams comprise police, lawyers, and other investigative experts through branches in Toronto, Vancouver, Montreal, and Calgary. They are jointly managed by the RCMP and Justice Canada and work closely with securities regulators such as CIRO and other federal and provincial authorities. Money laundering is the process in which the proceeds of crime are converted into legitimate funds using complex transactions, usually through financial institutions. The MFDA, Mutual Fund Dealers Association, is formerly the self-regulatory organization that regulated the distribution, dealer side of the mutual fund industry in Canada. The MFDA merged with IROC and became the Canadian Investment Regulatory Organization, also known as CIRO. National instruments, these are policies that apply in all Canadian jurisdictions and have the force of a binding rule. A passport system is a system which gives issuers a streamlined access to the capital markets in multiple jurisdictions by dealing and filing documents with only its principal regulator, also known as a PR, and meeting the requirements of one set of harmonized laws. What this means is that where an issuer files a prospectus in its principal jurisdiction with its PR, if the PR issues a receipt and the issuer gave notice to the local jurisdictions in which it otherwise wouldn't have filed the prospectus as well, the other jurisdictions will automatically issue a deemed receipt. A regulator is a general term referring to the securities administrators and self-regulatory organization, an SRO collectively. Primary distribution is a distribution of securities, generally by the issuer from its treasury. All primary offerings are distributions which requires the use of a prospectus or the availability of a prospectus exemption. Secondary trading is the trading of securities through an exchange or over-the-counter subsequent to a primary offering. The proceeds from trades in a secondary market go to the selling dealers and investors, rather than to the companies that originally issued the shares in the primary market. An SRO, also known as a self-regulatory organization, is an organization recognized by the securities administrators as having powers to establish and enforce industry regulations. Its main functions are to protect investors, maintain fair, equitable, and ethical practices in the industry, and ensure conformity with securities legislation. In Canada, the SRO is the Canadian Investment Regulatory Organization, also known as CIRO. UMIRs, also known as Universal Market Integrity Rules, are a common set of equities trading rules enforced by CIRO and designed to ensure fairness and maintain investor confidence. These rules create the framework for the integrity of trading activity on marketplaces and allow for the competitive operation of exchanges and alternative trading systems, ATSs, in Canada. Investment Industry Regulatory Organization of Canada, IROC, is formerly the National Self-Regulatory Organization, overseeing all investment dealer members and trading activity on equity and debt marketplaces in Canada. IROC merged with the MFDA and became the Canadian Investment Regulatory Organization known as CIRO. Secondary distribution refers to the redistribution or resale of previously issued securities to the public by a dealer or investment dealer syndicate. A registrant refers to individuals registered with the securities administrators or self-regulatory organizations. The purpose of regulation in the securities industry is to ensure a fair and efficient securities marketplace and protect investors. The key regulatory areas are disclosure by issuers, so companies must provide prescribed information before selling new securities, ongoing disclosure. Public companies and insiders must provide continuous updates to help market participants make informed decisions. Conduct rules for distributors, so dealer members and employees must follow rules when providing information or making recommendations. Supervision, firms must supervise employees and handle client assets with care. And registration requirements. Firms and registrants must be properly licensed to perform registrable activities. Learning Objective 1, identify the principles of securities regulation. Role of securities regulators is the following. The securities legislation exists in each province to regulate primary and secondary securities markets. Regulatory authorities include commissions, administrators, or registrars, and they're coordinated nationally via Canadian Securities Administrators, also known as the CSA. The mandate here is to protect investors and promote market integrity and efficiency. Some examples of regulatory mandates in practice include the British Columbia Securities Commission, which serves fair, efficient markets and a competitive industry, the OCS, also known as the Ontario Securities Commission, which serves to protect investors and foster confidence in markets, and CIRO, which is an SRO, which ensures efficient, consistent regulation and public trust. So the key takeaway here is investor protection and market integrity are core principles of these mandates. On the topic of licensing and privilege, it's important to note that licensing is a privilege, not a right. Regulators can suspend or revoke licenses for misconduct. Licensing ensures participants meet standards of proficiency, integrity, and financial compliance. The three broad principles of regulation are: number one, disclosure, to provide investors with the information needed for reasoned decisions. Number two, registration. Dealers, advisors, and other participants must be registered. And number three, enforcement, to investigate and penalize misconduct and maintain public confidence. The principle of disclosure is full, true, and plain disclosure is required for public offerings. A prospectus is a contract with investors. And continuous disclosure ensures secondary market transparency, including the following: financial statements and MD&A, material change reports, insider trading reports, and proxy information. Principle of registration. Administrators register dealers and advisors to ensure competence and integrity. Investment dealers must also comply with SRO rules, so CIRO, for example, and registration can be suspended or canceled if not in the public interest. Enforcement and compliance. Administrators can investigate violations, prosecute misconduct, levy fines, freeze assets, or suspend trading. The purpose here is to protect investors, uphold market integrity, and deter fraud. So administrators can investigate, prosecute, and impose sanctions for conduct against public interest. And to expand on that, they have quasi-judicial powers, including compelling witness attendance and taking evidence under oath. Also seizing documents, freezing funds or securities. And apart from levying fines and suspending, canceling, or revoking registration, they can also order disgorgement or halt trading. The consequences of this can be serious. So losing your registration is essentially losing your ability to work, which means halted securities. So that's reduced capital raising ability. Some provinces, they give administrators broader powers to prevent someone from being a director or officer. They can also issue public reprimands. Violations can lead to criminal charges, fines, or imprisonment, and appeals can be made to courts. Obviously, this is a very lengthy process. Prohibited actions include participation in fraudulent activities, creating misleading trading activity or artificial security prices, making untrue statements affecting market value. And regulations can't fully prevent losses in the securities market, so laws aim to reduce fraud and protect inexperienced investors without stifling legitimate business. Investors and advisors still need to assess investments carefully before buying and regularly while holding them. So over here we have an example from the textbook. The maximum penalties for offenses under the Securities Act in Ontario are a fine of $5 million and imprisonment for a term of not more than 5 years less a day. The OSC also has the power to order the payment of an administrative penalty up to $1 million and to order the disgorgement of monies obtained as a result of non-compliance with Ontario securities law. The Securities Acts all contain secondary market civil liability provisions. Investors are not required to prove they relied on misleading disclosure when buying or selling stock or other securities. This one's really important to note. The provinces also have the power to order repayment of a financial loss to a member of the public resulting from illegal or improper trading. Risks and investor responsibility. Securities law cannot guarantee profits or prevent all losses. Investor education is key here, so that means evaluating investments before purchase and just accepting risks as part of investing. Registered reps must document client risk disclosure. The key takeaways from learning objective 1 of this chapter are securities regulations exist for investor protection and market integrity. The 3 core principles are disclosure, registration, enforcement. Licensing is a privilege, so misconduct has serious consequences, and continuous disclosure and compliance maintain fairness and confidence in capital markets. Learning objective 2, identify the key players in Canadian securities regulation. The focus of this objective is to identify who regulates what. So securities regulation in Canada, the big picture. Securities regulation in Canada operates at 3 levels: federal, provincial/territorial, and industry. So that includes self-regulatory organizations. Unlike the US, Canada has no single national securities regulator, and regulation is coordinated to protect investors, market integrity, and confidence in capital markets, as we just discussed. Canada is decentralized, but a coordinated system. Federal government role. The federal authorities are a key player. Their role is indirect but critical. So Canada has no federal securities commission, meaning federal involvement occurs through the Canada Business Corporations Act, including proxy solicitations and insider trading for federally incorporated companies. Bank regulation. So banks are federally regulated and their securities subsidiaries are provincially regulated. Federal laws affecting securities dealers include the PCML-TFA, the Proceeds of Crime and Money Laundering and Terrorist Financing Act, PIPEDA, Personal Information Protection and Electronics Documents Act. So PCML-TFA is Canada's primary legislation aimed at detecting/deterring money laundering and terror financing. It requires financial institutions, real estate brokers, and other entities to report suspicious transactions and keep records to assist FinTrack. The Act was last updated in 2025, and it imposes strict compliance obligations with significant penalties for violations. PIPEDA is Canada's federal private sector privacy law, regulating how businesses collect, use, or disclose personal information during for-profit commercial activities. It requires informed consent, limits data usage to reasonable purposes, and enforces 10 fair information principles to protect individual privacy. FinTrack and financial crime oversight. FinTrack and federal enforcement bodies are key players here. It's important to note that anti-money laundering is federal and not provincial. So FinTrack enforces PCML-TFA and oversees suspicious transaction reporting along with large cash transactions. Securities dealers must comply with anti-money laundering obligations, client identity verification, and ongoing monitoring. Integrated Market Enforcement Teams, also known as IMETs, are another key player. Launched in 2003, was a joint initiative of the RCMP and federal government. The purpose here is to detect, investigate, and deter capital markets fraud, and they work closely with securities regulators, CIRO, and exchanges. Another key player we have is the JSOT, Joint Serious Offenses Team. It's an Ontario-specific enforcement team launched by OSC in 2013 as a partnership between the OSC, RCMP Financial Crime Program, and the Ontario Provincial Police. Its focus is on serious fraud and major securities misconduct, and its uses are in the Securities Act in Ontario and the Criminal Code. The JSOT is Ontario only. So the next one is provincial and territorial regulators. The key player is provincial securities commissions. Each province and territory regulates securities within its borders. For example, the OSC is in Ontario, the BCSC is in British Columbia, the AMF is in Quebec, the ASC is in Alberta, and their responsibilities are registration, disclosure oversight, and enforcement. Provinces cooperate through harmonized rules. So provinces are also primary securities regulators. And then we have the CSA, the Canadian Securities Administrators. The CSA is a coordination body, and it's an umbrella organization of all provincial and territorial regulators. It's not a regulator itself. And its mission is to protect investors, foster fair and efficient markets, reduce risks to market integrity. It produces national instruments adopted everywhere, and multilateral instruments, MI. So these are not universal. And the CSA coordinates, whereas the province enforces. Okay, let's go over CSA tools and systems. So essentially how regulation is delivered. Key tools include the passport system, which fosters mutual reliance among provinces and reduces duplicate filings. Super MOU, which assigns a principal regulator to marketplaces. And then we have electronic databases, which include CDAR, SETI, and SETI? I think it's SETI. CDAR, SETI, and the National Registration Database. So CDAR is an issuer for disclosure and filings, and it's actually replaced multiple legacy systems. SETI is for insider trading reports, and over here we have a more detailed description of the electronic databases from the textbook. The CSA maintains electronic databases to streamline regulatory processes and make information more easily available to the market. CDAR is the web-based system used by all market participants to file, disclose, and search for information in Canada's capital markets. In July 2023, it consolidated and replaced the system for electronic analysis and retrieval, CDAR, the National Seized Trading Order, CTO database, and the Discipline List, DL database. Future phases of CDAR will replace the System for Electronic Disclosure by Insiders, SETI, and the National Registration Database, NRD, and the remaining filings in the local systems. SETI allows insiders to file insider reports with all CSA regulators through a single submission over the internet. The public can access insider reports soon after they are filed. This is a really important tool. And NRD, the National Registration Database, is a database that allows dealers, underwriters, and advisors and individuals to submit registration applications, changes, renewals, and fees electronically in a single submission to all regulators. So in addition to this, the CSA keeps constituents fully informed of its activities through regular notices, news releases, and publications regarding major initiatives and enforcement activities. In terms of industry self-regulation, we have a key player, CIRO, the Canadian Investment Regulatory Organization. It's Canada's self-regulatory organization, and it oversees investment dealers, registered representatives. Responsibilities include rulemaking, member discipline, product and client type approval. It works alongside the CSA and provincial regulators. So CIRO regulates conduct, whereas the provinces license. Okay, let's go over international regulatory players. Key players include global coordination bodies, so the IOSCO, the International Organization of Securities Commissions, which covers 95% of global securities markets and promotes global regulatory standards. Then we have the Financial Stability Board, the FSB, which focuses on systemic risk. Members include the Bank of Canada and the OSFI. The OSFI is the Office of the Superintendent of Financial Institutions. It's Canada's federal regulator that supervises and regulates banks, insurance companies, and private pension plans to ensure they are financially sound, safe, and stable, protecting depositors, policyholders, and pensioners, and maintaining public confidence in the Canadian financial system. So OSFI sets rules, monitors risks, and takes action to ensure these institutions manage threats like cyber attacks and foreign interference, keeping the system resilient. So these key players support cross-border cooperation and financial stability. They exist for coordination, not enforcement. Learning Objective 3, explain the role of the self-regulatory organization, the provincial regulators, and the marketplaces. So the goal here is to understand how securities regulation works in Canada and its key principles. An overview of SROs. SROs are industry organizations that regulate their own members. Official authority comes from provincial/territorial administrators through recognition orders. So recognition orders in Canadian securities are legal instruments issued by provincial regulators like the OSC, BCSC, or FCAA that officially authorizes entities such as stock exchanges like CSE and CIRO, self-regulatory organizations, to operate and regulate market participants. So SROs are delegated regulators. They're not government bodies, and their responsibilities include enforcing compliance with securities laws, prescribing rules of conduct and financial requirements. The Canadian SRO for investment and mutual fund dealers is CIRO. Let's expand on CIRO. CIRO oversees investment dealers, mutual fund dealers, and trading activity in Canada's equity and debt markets. It sets rules for business and financial conduct, along with registrants' proficiency, training, and supervision. Brief history of CIRO. We're going to go over some key points. So CIRO is a former IROC plus MFDA merger. IROC is the Investment Industry Regulatory Organization of Canada, and MFDA is the Mutual Funds Dealer Association. IROC was created in 2008 as a consolidation of the IDA. IDA is the Investment Dealers Association. It was a consolidation of the IDA plus Market Regulation Services. And the IDA was formed in 1916. Originally, it was called the Toronto Bond Dealers. A mandatory SRO membership was introduced in the 1990s. And then we have the IIAC, the Investment Industry Association of Canada. So it's a non-regulatory trade association, and it originated from the industry association arm of the former IDA. It advocates for industry growth and member support. So January 2023, we had a merger of IROC and the MFDA, and now we have CIRO. CIRO compliance and surveillance. CIRO compliance is ongoing firm supervision, and it exists to ensure that firms meet high standards in business conduct, financial compliance, and trading conduct. CIRO conducts financial compliance reviews and sets minimum requirements to ensure that firms have enough capital for their business's specific nature and volume. Capital requirements prevent firms from failing by preventing excessive leverage and risky business practices. CIRO-regulated firms also participate in the Canadian Investor Protection Fund, the CIPF, which protects individual investors in the unlikely event that a firm should go bankrupt. CIRO also carries out business conduct compliance reviews to ensure that their dealer members have proper supervision procedures in place. Supervision should include handling client accounts to ensure that advice and transactions appropriately reflect a client's needs and instructions. The accounts must be handled by RRs who are familiar with each client's financial situation, investment needs, objectives, investing experience, and risk tolerance. In other words, the RRs must follow the KYC, the Know Your Client, and suitability rules. Furthermore, CIRO carries out trading conduct compliance reviews to check trading firms' trade desk procedures. The reviews assess whether trade desk procedures comply with the Universal Market Integrity Rules, UMIR, and applicable provincial security laws. Finally, CIRO conducts market, surveillance, and trading review analysis to ensure that trading is carried out in accordance with UMIR and applicable provincial securities laws. CIRO enforcement and discipline. Enforcement staff investigate possible breaches of CIRO rules and discipline firms and individuals when regulatory misconduct is identified. Discipline can include fines, suspensions, and permanent bans or termination for both individuals and firms. CIRO is a member of the Intermarket Surveillance Group, the ISG, which comprises over 50 members worldwide, including all major stock exchanges. The mandate of the ISG is to promote effective market surveillance among international exchanges. Another CIRO initiative is a whistleblower service to evaluate reports of systemic wrongdoing. It takes prompt action on reported first-hand knowledge or tangible evidence of potential securities frauds or other unethical behavior by individuals or firms in the investment industry. What's the deal between CIRO and FINRA? CIRO and FINRA have an international regulatory partnership. CIRO and its U.S. counterpart, the Financial Industry Regulatory Authority, also known as FINRA, cooperates to enhance both organizations' effectiveness through exchanging information and other cross-border assistance. In addition to information sharing on compliance and enforcement-related matters, CIRO and FINRA work together on issues related to firm oversight and examinations. FINRA is the largest independent regulator for all securities firms doing business in the U.S. As such, it has the following responsibilities: protecting investors and market integrity through regulation, registering and educating industry participants and examining securities firms, writing and enforcing rules and the federal securities laws, informing and educating the investing public, providing trade reporting and other industry utilities, and administrating the largest dispute resolution forum for investors and firms. CIRO and Canadian marketplaces. For this, it's important to note that CIRO regulates trading and exchanges regulate listed companies. CIRO monitors trading activity on the following: on the TSX, the Toronto Stock Exchange, the TSX Venture Exchange, and ATS Alternative Trading Systems. Exchanges monitor compliance of listed companies, as stated earlier, and enforcement powers include halting trades, corrective disclosure, and terminating listings if necessary. Designated stock exchanges. Domestic and foreign-based exchanges must meet the following criteria to be considered a designated stock exchange by Canadian regulatory authorities. Only securities that are listed on a designated exchange are eligible to be held in RRSPs, TFSAs, or other registered accounts. As goes the following: the exchange must carry out the normal business of an exchange and listing securities, facilitating the trading, clearing, and settlement of these securities, monitoring and enforcing trades executed on its system, and offering transparent pricing information to the public. It must have acceptable standards for new company listings, including standards that address the number of shareholders and the dispersion of ownership, and for the maintenance of a listing. It must operate within a regulatory framework that meets acceptable standards in relation to investor protection, disclosure requirements, corporate governance, and marketing integrity as may be espoused by the IOSCO. It must have an experienced management and governance team, a successful track record of operations, and sufficient financial resources to ensure long-term viability. It must have a range of listings and adequate liquidity for investors to buy and sell securities at reasonable bid-ask spreads. Foreign-based exchanges must meet the following additional criteria. The host country of the exchange must have commercial, legal, and tax relations with Canada, as demonstrated, for example, by having entered into a comprehensive tax treaty or an agreement on the exchange of tax information. The host country must be a member in good standing in the international financial community through membership in such organizations as the World Trade Organization, the IMF, IOSCO, the Financial Action Task Force, or similar bodies. The securities regulatory and juridical framework of the exchange's host country must provide rights and remedies to Canadian investors, including brokers acting on investors' behalf, which are comparable to those available to investors in Canada. The exchange must be recognized by host government and other foreign governments where applicable for tax purposes comparable to those for designated exchanges under the Canadian Income Tax Act. And the host country of the exchange be at low risk of imposing capital restrictions or other impediments on the liquidation of investments and the repatriation of funds by foreign investors. On the topic of designated stock exchanges, it's really important for you to know as an RR that you should be mindful of changes to securities that may make them no longer eligible to be held in registered accounts. You should also know your firm's policies regarding pink sheet or over-the-counter listed companies. To quickly summarize CIRO's roles, compliance exists for firms to follow high standards, surveillance for market integrity and UMIR rules, enforcement to discipline members for breaches, collaboration for domestic and international regulators, and investor protection, which includes CIPF, whistleblower reporting, and proper supervision. So CIRO is a central SRO ensuring regulatory compliance across Canada. Scanning this QR code will take you to a complete list of designated stock exchanges, which can be found on the Department of Finance Canada's website at the link below. This is referenced in the textbook. Learning Objective 4. Describe the role of the Canadian Investor Protection Fund, CIPF, and the limits of its coverage. An overview of investor protection funds. The purpose is to protect investors against losses from the financial failure of dealer members, not designated to cover market losses or poor investment performance, and they're vital for maintaining public confidence in dealer-client relationships. It's important to note here that the CIPF is not market insurance. It only covers member insolvency. CIPF, the Canadian Investor Protection Fund. It provides coverage from the moment an investor becomes a client of a member firm and maintains two separate funds. A is the Investment Dealer Fund for CIRO members registered as investment dealers, and B, a Mutual Fund Dealer Fund for CIRO members registered only as mutual fund dealers. So coverage depends on the type of dealer membership. Funding and member obligations. CIPF is sponsored and funded by CIRO member firms, and member obligations include paying regular and special assessments promptly, sharing financial and operational info with CIPF, allowing CIPF to conduct operational reviews, cooperating with actions directed by CIRO or CIPF. Member cooperation is critical for investor protection. What CIPF covers? CIPF covers losses in client securities and cash balances if dealer becomes insolvent. It does not cover losses from market fluctuations, it does not cover unsuitable investments, and it does not cover default of a security issuer. So CIPF is dealer insolvency protection. It's not investment risk protection. Okay, CIPF coverage limits. This one's important. So the maximum coverage per general account is up to 1 million. Separate accounts are also entitled to 1 million each. Accounts belonging to a single client are combined for coverage purposes, and coverage applies to joint accounts proportionally. Coverage is per client, per account type, up to 1 million. General accounts. It's really important to know the difference between general and joint accounts for CIPF coverage. Accounts belonging to a single client, including cash, margin, short sale, options, futures, and foreign currency accounts, are combined and treated as one general account. The combined amount is entitled to the maximum coverage. In addition, a client's proportionate interest in an account held on a joint or shared ownership basis is combined with the client's general account. However, if clients share a joint account at an insolvent firm but do not have individual accounts at the same firm, the proportionate interest of each client in the account is treated as a separate account. Each client would therefore be eligible for coverage to the limit of $1 million. Here's an example from the textbook for general accounts. The example here is Jonas and Daryl each has an account in his own name. Jonas's account is worth $700,000 and Daryl's is worth $500,000. The couple also shares a joint account worth $1.2 million. The couple's accounts are entitled to CIPF coverage in the following amounts. For Jonas, he has an individual for $700,000 plus $300,000 for joint, so $1 million. Daryl for $500,000 individual plus $500,000 joint, also $1 million. Because each client has reached his maximum coverage in a general account, the remaining $400,000 in the joint account is not covered by CIPF. So they're each capped at $1 million. Separate accounts are treated as distinct coverage units. They're treated as if they belong to separate clients, with maximum coverage being $1 million per separate account. Examples include RRSPs, RIFs, LIFs, LIRAs, LIRSPs, LRIFs, RESPs, testamentary/inter vivos trusts, personal holding corporations, partnerships, and unincorporated organizations. Okay, so RSPs are registered retirement savings plans. They are tax-deferred registered accounts used to save for retirement. Contributions are tax-deductible, investment growth is tax-deferred, and withdrawals are taxed as income. They must generally be converted to a RRIF, annuity, or withdrawn by the end of the year the holder turns 71. RRIFs are registered retirement income funds, registered plans that provide retirement income after RRSP conversion. They have minimum annual withdrawals, which are required and are fully taxable as income. Investment growth inside the plan remains tax deferred. LIFs are life income funds. They're locked-in retirement income vehicles used to receive income from pension assets transferred from a registered pension plan, an RPP. They're subject to minimum and maximum withdrawal limits set by legislation. Then we have locked-in retirement accounts / locked-in retirement savings plans, LIRA/LIRSP. Registered accounts holding pension assets transferred from an employer pension plan when employment ends. So funds are locked in and generally they cannot be withdrawn as cash. They must later be converted to a LIF, LRIF, or annuity. And then we have locked-in retirement income funds, LRIFs. So they're income funds similar to LIFs, but governed by older provincial legislation. For example, in Ontario, they allow for income payments with prescribed minimum and maximum withdrawal limits. Many provinces now favor LIFs over LRIFs. Then we have registered education savings plans, RESPs, which are awesome. Registered plans, they're used to save for a child's post-secondary education. The contributions are not tax deductible, but investment growth and government grants, for example, CESG, are tax deferred and taxed in the student's hands when withdrawn. Testamentary trusts are trusts created upon death through a will. They're assets that are administered according to the terms of the will, often for estate planning, tax management, or beneficiary protection purposes. Then we have inter vivos trusts. They're trusts created during the lifetime of the settlor, commonly used for estate planning, tax planning, and asset protection. Income is generally taxed at the highest marginal rate unless exceptions apply. Personal holding corporations are corporations primarily used to hold investments or passive income rather than conduct active business operations. They're often used for tax deferral, income splitting, and estate planning, but they're subject to tax rules on passive income. And then we have partnerships, so business arrangements where two or more parties carry on business together with a view to profit. Income and losses flow through to the partners that are taxed in their hands. Common structures include general and limited partnerships. And lastly, unincorporated organizations. They are entities that are not legally incorporated, such as sole props, clubs, associations, or informal business groups. They do not have separate legal personality, and income is taxed directly to the owners or members. Here's an example from the textbook for separate accounts. If one client has two RIFs, the accounts would be combined and treated as one separate account. So if one person has two accounts in trust, one for a daughter and the other for a son, the accounts would be treated as two separate accounts. In other words, they would not be combined with each other, nor would they be combined with either child's personal accounts. However, the accounts must be genuine trusts, and the beneficiaries must have been disclosed when the accounts were opened. Coverage is determined on a case-by-case basis. So when we talk about the compensation process, CIRA monitors member firms' capital, liquidity, and risk. And for insolvent firms, when a dealer member becomes insolvent, the CIPF appoints a trustee in bankruptcy. Each claim is considered according to the policy adopted by CIPF's Board of Governors. Under the policy, certain persons and entities are not eligible customers and therefore not entitled to CIPF protection. Likewise, certain losses in the accounts of eligible customers are not covered. The CPIF's website has its full coverage policy if you want to go explore that. So, yeah, claims assessed are per CIPF policy, and certain persons/entities may be ineligible for coverage. International coordination. The CIPF has a Memorandum of Understanding with U.S. Securities Investor Protection Corporation, also known as SIPC. It's a collaboration for firms operating in both Canada and the U.S., and it's to enhance efficiency in cross-border insolvency cases. So international coordination ensures client protection across borders. Other protection funds. The CDIC, the Canada Deposit Insurance Corporation, is federal and it insures bank deposits up to $100,000. Then we have the Provincial Deposit Insurance, which covers credit unions, trust, and loan companies. Examples include the BC Credit Union Deposit Insurance Corporation, in Ontario, the Deposit Insurance Corporation of Ontario, and Quebec, the AMF Deposit Insurance. So CIPF covers securities, and CDIC, or Provincial Insurance, covers deposits. Key takeaways for the Canadian Investor Protection Fund. So it covers losses only from dealer insolvency. Maximum coverage, $1 million per account type. There's a separate versus general accounts. There's a difference, and depending on which account we're dealing with, it determines the coverage. Clients must be with CIRA member firms, and works with international counterparts for cross-border coverage. So remember, CIPF is not market loss insurance. We have to remember the account type rules. Learning Objective 5. Describe anti-money laundering and anti-terrorist financing requirements. So money laundering and terrorist financing in securities. Securities are attractive for laundering due to diversity, liquidity, and global reach. Criminals and terrorist organizations generate funds that must appear legitimate. Securities industry can be used to launder funds or finance terrorism, and dealer members help limit access to markets and detect suspicious activity. What is money laundering? The definition is converting proceeds of crime into seemingly legitimate funds. So criminals disguise source, form, or location of money, and securities transactions can obscure audit trails and ownership. The key point here is that money laundering is making illegal funds appear legal. 3 stages of money laundering from the textbook. The three basic stages of money laundering, which can be thought of as the wash cycle, spin cycle, and dry cycle, are placement, layering, and integration. Placement involves the physical disposal or deposit of cash proceeds derived from an illegal activity within the legitimate financial system. One of the following methods might be used for this purpose. Structuring, which involves breaking up large amounts of cash into smaller, less conspicuous sums. The so-called structured deposits are subsequently deposited directly into bank accounts, always in amounts lower than levels that they must report. Mingling criminal proceeds with deposits from legitimate cash businesses such as stores, bars, and restaurants. Bribing the personnel of a bank or other financial institution to accept deposits without reporting them. Smuggling cash into countries with lax anti-money laundering requirements. Purchasing a series of monetary instruments such as certified checks or money orders that are then collected and deposited into accounts at another location. The investment business is generally not cash-based, so it is less at risk from the initial placement of criminally derived funds than mainstream banking operations. Most payments to brokerage accounts are made by way of checks or transfers from other financial institutions. By the time the funds reach a dealer member, they have likely already gone through the placement phase. The next stage is layering. Layering involves separating illicit proceeds from their source by creating complex layers of financial transactions. The transactions are designed to obscure the audit trail and hide the original source, thereby providing anonymity. The securities industry is more at risk at this stage. Funds can easily be converted into entirely different assets and combined in an investment portfolio with lawful assets. The origin of the funds may be concealed by executing numerous buy and sell transactions of various investment instruments. Alternatively, the launderer may simply wire the funds through a series of accounts of various banks across the globe. Integration. Integration involves placing the laundered proceeds back into the economy in such a way that they appear to be normal business funds. Frequent techniques include the use of corporate entities controlled by the launderers through which they make loans to themselves. Repayment, of course, is unnecessary. They may also use the funds to purchase real estate they can use without charge, either as personal property or as a business to generate additional, seemingly legitimate income. Money laundering mechanisms in securities can look like multiple trades across different brokerages and jurisdictions. It could look like using shell companies to conceal beneficial ownership, or publicly traded companies used as fronts to launder funds and profit simultaneously. An example from the textbook is a long position at one dealer and a short position at another. This would be offsetting trades to disguise profit. The example is right here. So at ABC Securities, a money laundering outfit takes long positions in euro-dollar futures contracts. At the same time, they short the exact same contracts at another dealer member. One side of the trade reports a capital gain, whereas the other side reports a loss. In other words, the two transactions offset each other, with the cost being primarily the cost of the two commissions. The proceeds of the profitable side have the appearance of legitimacy, whereas the losses on the other side are concealed. Terrorist financing detection is difficult due to legitimate appearance of funds. The definition of terrorist financing is funds used to support terrorist activities. It's not always profit-driven. It can come from legitimate sources like charities, and it typically involves smaller, less complex transactions than criminal laundering. So, key anti-money laundering and anti-terrorist financing regulations. Proceeds of crime, like Money Laundering and Terrorist Financing Act, PCM-LTFA. The objectives are to detect and deter money laundering and terrorist financing, to respond to organized crime threats, to fulfill Canada's international obligations. These regulations are supplemented by SRO rules, so CRO for the securities industry. Dealer member obligations. Dealer members must implement procedures for number 1, client identification, know your client, number 2, record keeping of transactions and client information, and number 3, reporting. So this includes suspicious financial transactions and cross-border movements of currency and monetary instruments. KYC plus reporting is usually the first line of defense against money laundering. Role of FINTRAC. FINTRAC is the federal watchdog for anti-money laundering and anti-terrorist financing compliance. Financial Transactions and Reports Analysis Center of Canada, also known as FINTRAC, monitors compliance with PCMLTFA. It collects and analyzes and discloses information to detect and prevent money laundering and terrorist financing, and provides information to law enforcement, the CRA, CSIS, and Immigration Canada. Reporting suspicious transactions. Dealer members must report suspicious transactions above threshold or unusual patterns, international currency or monetary instrument movements, and transactions inconsistent with client's profile or investment activity. So reporting does not require proof of wrongdoing. Reasonable suspicion is enough. Compliance programs prevent fines and protect market integrity. Dealer members must establish anti-money laundering and anti-terrorist financing policies and procedures. They must establish employee training on detection and reporting. They must establish internal controls and audits to ensure regulatory compliance, and they must establish cooperation with SRO and federal authorities. Securities industry vulnerabilities. So the following are some vulnerabilities we have: high liquidity and ease of global transactions, the use of shell companies or offshore accounts, multiple institutions and jurisdictions involved in one laundering scheme. Examples include fraudulent trades between brokers and investing illegal funds in public or private companies. Key takeaways. Anti-money laundering and anti-terrorist financing regulations are critical for market integrity. Dealers play an essential role in identifying and reporting suspicious activity. FINTRAC ensures compliance and assists law enforcement. PCMLTFA and CERO rules are enforceable frameworks in securities. Oh, and don't forget, remember the 3 stages of money laundering and dealer responsibilities. The first is placement, the second is layering, the third is integration. So it's a wash, spin, dry cycle. Then we have a Chapter 3 summary. The securities industry in Canada is regulated by the provincial securities commissions and SROs, and to a smaller extent by federal legislation. The securities acts of each province are based on the 3 basic principles of regulation: disclosure, registration, and enforcement. Disclosure is the transparency for investors, registration for proper licensing of firms and individuals, enforcement for ensuring compliance and addressing violations. Each province regulates securities activities within its borders, and attempts to create a formal national regulator have been unsuccessful so far. However, the provinces have managed to harmonize their regulations through meetings of the CSA and through the reformulation and implementation of national instruments. From an industry point of view, regulation is conducted through SROs that have been given the privilege of regulating their own members. SROs are responsible for enforcing conformity with securities legislation and have the power to prescribe rules of conduct and financial requirements for their members. As well as the securities industry being heavily regulated to protect investors, the Canadian Investor Protection Fund is set up to guard against losses due to the financial failure of SRO member firms. So, in Chapter 3, we reviewed the regulatory landscape in the securities industry and discussed the standards of conduct that underlie ethical decision-making.